40 million American homeowners. That's nearly 1 in every 3. And according to new data, by the end of 2026, many of them could lose everything. But not because of a crash, not because of some wild market collapse. It's because the math no one wants to talk about is already baked in. Let's rewind. The year is 2020. Interest rates are near zero. Everyone's home office looks like a mini trading floor, and Zillow browsing is the new national sport. Cheap money is everywhere. Your neighbor's refinancing. Your friend in Dallas is flipping homes. TikTok gurus are selling the own it, rent it, retire early dream. By 2022, average US home prices had jumped over 40%. And at first, that looked like wealth. But wealth on paper isn't cash in the bank. It's debt. Massive debt. Now, here's the plot twist. Most of those mortgages were 30-year fixed. Sounds safe, right? But safety has a hidden expiration date. Because owning property in America doesn't mean you own your costs. It means you're renting stability from interest rates, insurance companies, and tax assessors. And all three are exploding. You see, beginning in 2023, property insurance premiums in high-risk states, Florida, California, Texas, didn't just rise, they tripled for some families. And local taxes followed right behind, because when prices rise, tax assessments rise. When tax assessments rise, monthly escrow payments balloon. Even if your mortgage is fixed, your total cost isn't. So a couple who bought in 2021 with a $2,200 monthly payment is now paying almost $3,000 without refinancing, without moving, without upgrading a thing. Now, multiply that by tens of millions of households. That's how 40 million homeowners quietly get cornered. But there's another layer. In 2021, nearly 70% of new mortgages came from government-backed institutions, Fannie Mae, Freddie Mac, or FHA. And those programs locked millions of middle-class families into debt at the peak of inflated valuations. Target like of this video is 10K. If this video get 10K likes, we make a free advanced level share market course, free of cost. So please don't forget to like video, not let's go further. People thought they were locking safety. What they really locked was maximum exposure. Because when prices fall even slightly, 10, 15%, your refinance options vanish. Your equity cushion disappears. And if inflation stays sticky or insurance pulls out of your area, you have one way out: sell. Except, who are you selling to when new buyers can't afford your same house with today's rates? That's the trap. This isn't a crash like 2008. It's slower, more polite. Instead of exploding overnight, it erodes over months, tax bill by tax bill, renewal notice by renewal notice, until for many families, the dream just stops working. Now let's look at the timeline. 2024. The Fed holds rates high to squeeze out inflation. Mortgage demand falls 25%. Banks quietly tighten credit. 2025. Property insurers exit entire zip codes. FEMA classifies dozens more flood zones. Local municipalities raise taxes to cover shrinking budgets. 2026. Expiration cliff. Over 5 million homeowners reach the end of temporary insurance discounts or tax abatements offered during those early stimulus years. By Q4 2026, the average homeowner in southern states faces an unbudgeted $6,000 per year increase in holding costs. That's more than many families' annual savings. And that's before maintenance, before inflation, before job loss. It's a slow-motion squeeze, not a collapse of prices, but of ownership itself. Now, some will say, but the market's fine. Home prices are up again. True, on paper. But let's ask a darker question. Priced for whom? If home ownership becomes impossible to afford even when you already own, Who becomes the buyer of last resort? Institutional investors. Since 2011, mega funds like Blackstone, Invitation Homes, and others have been buying up single-family homes in bulk, renting them back to families who once were homeowners themselves. In 2025, institutional ownership crossed the 7% mark nationwide, rising to over 30% in some metro areas. And every foreclosure, every forced sale, every over-leveraged exit feeds them more inventory. The American dream, it seems, is becoming a corporate asset class. You see, this isn't just a story about economics. It's about power. Who holds it when households lose theirs? And it's happening right now, behind the illusion of stability. If you're watching this, I want to ask you something. What would you do if the cost of keeping your home rose 30% in 2 years, but your income didn't? Would you sell, rent it out, fight the taxes? Drop your thoughts below. I'm reading and replying to the most interesting takes. And if you want to track how this unfolds month by month, you know what to do. Subscribe. Because the second half of this story hasn't even started yet. Let's go deeper. Why exactly are costs spiraling when prices have slowed? 3 words: policy, weather, and math. Policy. Local governments can't print money like the Fed, so when inflation drives their costs up, they raise property taxes. Weather. Climate risk keeps pushing insurers out, and replacement policies cost double or triple. Math. Even at fixed mortgage rates, escrow adjustments, HOA fees, and revaluations keep compounding. Now, each of these pressures feeds the other. Towns raise taxes because insurance payouts increase rebuilding costs. Homeowners claim more insurance because storms keep coming. Premiums go up because risk models say expect worse. And when pension funds, retirement accounts, and private equity groups invest in all these underlying instruments, suddenly everyone's exposure is tied together. Local debts become national. So the question isn't just who loses homes, it's who gains control after they do. Let's zoom out. In the next 24 months, an estimated $1.6 trillion in household real estate debt will roll into maturity or need refinancing through secondary markets. But with rates staying above 6%, fewer banks want to hold that paper. They'll sell it at discounts to larger funds or asset managers. So even without one dramatic crash, ownership shifts from millions of families to a few institutional hands. Without headlines, without protests, just quiet paperwork. A transfer of wealth so smooth, most will call it stability. Now, here's the irony. The very same inflation that makes life harder for average homeowners protects the institutions who'll buy their homes later. Because inflation erodes debt value, and these entities borrow at scale, the system rewards the players who can outlast pain, and history shows they usually do. From the Great Depression to 2008, every housing downturn followed this pattern: extreme liquidity flows to whoever can hold assets the longest. Families sell from fear, funds buy from patience. Now, here's where the stakes rise. If current forecasts hold, by mid-2026, home ownership rates in America could drop below 60% for the first time since 1950. That shift, in one generation, rewires everything: politics, retirement, neighborhood identity, even fertility rates. Because when people stop believing in ownership, they start living differently. Disposable, transient, cautious. That belief used to be America's anchor, and quietly, it's slipping. But nothing is inevitable. Some cities are already experimenting with shared equity models and cooperative housing trusts. Some states are fighting back against institutional ownership caps. Others are doubling down on property tax relief. Will it be enough? Hard to say. America's economy runs on confidence, and the story we tell about home ownership has always been its most powerful myth. But myths only work as long as the math adds up. And right now, the math doesn't. 40 million homeowners. The countdown to 2026 is already ticking. So the question isn't if they'll lose everything, it's who else will gain what they leave behind. Please comment your thoughts and don't forget to subscribe.